And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Bianco Research founder Jim Bianco. Jim is known for his graphs and charts. There is a chart deck to accompany this week's interview. We won't be going over the slides page by page, but you're going to want to download this chart deck because there are charts and graphs that will supplement a number of different conversation topics that we're going to touch on today. Registered users will find the download link in your Research Roundup email. If you're not yet registered, just go to our homepage, macrovoices.com, look for the red button above Jim's picture that says Looking for the Downloads. Jim, it's great to get you back on the program. You know, I had Russell Napier on the show last week, and something I'm noticing, Russell was one of the devout deflationists for the last several years. And I'm seeing really smart people who were convinced it was deflation coming around to an inflationary view. I'm very curious what your reaction is and what your outlook is in terms of inflation versus deflation, particularly in light of the change of the presidential administration and all of the stimulus that's being contemplated.
Well, I would probably put myself somewhat into Russell's camp. I wasn't a deflationist until this summer, but I was always arguing, I was a bond bull, and I was saying that inflation is not a problem. But then this summer, I jokingly say I became an inflationista this summer. And I'm looking for higher levels of inflation as we move forward from here. Now, why? I think the biggest thing is the amount of government stimulus. We're mailing people checks. We mailed them a $1,200 check in the spring. We're just finishing up mailing them a $600 check. We're going to mail them a $1,400 check. We're giving people extra money for unemployment. They were getting $600 a month until August. They're now getting $300. And if the new stimulus package that's being negotiated stands as is being presented, that $300 will last all the way through to September 30th, plus bailouts for the states as well and the cities and a whole bunch of other stuff. And then they'll start on an infrastructure spending program right after that. A lot of people ask me, well, how can you have inflation if there's no wage inflation? And I said, right at large. This is about a larger measure called personal income, which the biggest thing on personal income is wages. But in 2020, a record 20% of all of the income that the American public got came from the government mailing it to them. So 1/5 of all the money came from the government. And there's more checks going out now, and they're debating even more checks. Too much money, is what I think it is. And that will eventually chase into too many goods. Now, short term, that money is being saved. There is a fear about the economy. Right now, it's not open. A lot of people unemployed. They're not in the mood to go out and purchase a car, remodel their kitchen, because they don't know what their job situation is going to be. So, and I know we'll talk about this later. So they've been saving it, and that's been finding its way into brokerage accounts, and all of the Wall Street bet stuff and everything else has been fostered by that as well, too. But I do think, though, that there is a consequence to all this money printing. And the more you do it, the more it will stimulate the economy. And I also think that it's not going to stop. My leftist economist friends say, this is not enough to create inflation. And my response to them, other than debating whether it's enough, is who said they're done? They're going to keep going until we go too far. If all we've done is send people money, and the argument is the poor got something, maybe it wasn't as efficient as we liked. The unemployed got a bridge, they got some extra money. And a lot of it went into brokerage accounts that helped push the stock market to new all-time highs. Isn't the answer there everybody won? So if everybody won, send them more money. And then if they win again, which we just did, we sent them more money and the stock market's back at all-time highs, send them more money again and again until we go too far. And I think too far is inflation.
Now, Jim, the study of what causes inflation and what controls inflation, unfortunately, in the study of economics, feels to me oftentimes more like religion than science. But at least one of the versions of that religion says, okay, the way this inflation stuff works is, they provide accommodation, they do things to stimulate the economy. Eventually it goes too far, you get to inflation, and the remedy is the government simply increases interest rates, and that arrests the inflation, and it's all cured. The thing is, Jim, what it seems to me that we're headed toward is what I'll call an inflation trap, where you get to that point where it's time for the Fed to raise short-term interest rates aggressively in order to contain the inflation, stop it from running away, but they can't, because doing so would bankrupt the U.S. government, because we've got so much more debt on the books than we did 20 or 30 years ago. Would you agree that this idea of what has to eventually contain inflation, does this idea of increasing interest rates really even come into play? Because that's not necessarily science, that's more religion. And if so, would you agree that there's a trap set up that might be on the horizon?
Yeah, let's look back at the last two cycles, just as a quick measure of what's been happening with the Fed. And I'm talking about December of 2018. The Fed had made noise all through the fourth quarter of 2018. We're going to reduce the size of the balance sheet. And then on December 19th, Jay Powell holds a press conference and he says, we're going to reduce the balance sheet by $60 billion a month. It will be on automatic pilot and it'll be about as interesting as watching paint dry. The stock market fell 3% in the 1 hour of his press conference and kept getting crushed all the way through Christmas Eve. It was down 19.8%, nearly a 20% correction from its September 2018 high to Christmas Eve. January 4th, Powell was speaking at the American Economic Association annual meeting in Atlanta, and he did what is famously known as the Powell pivot, where he said, no, where the Fed's going to be patient and flexible. So the Fed spent months and months and months, articulated a plan to reduce the balance sheet. Market didn't like it. 10 days later, forget it. We're now patient and flexible. Let's go to a year ago. The late January meeting, the Fed held the funds rate steady at 2.5%. Everything's fine. We see no reason to be doing anything with the funds rate for as far as we can see. Literally hours after that meeting, the market started to wobble because it started to become aware of the coronavirus coming out of China. Within 15 days of that meeting, the Fed cut the funds rate 50 basis points. And within a month of that meeting, the Fed had put rates at zero. So my point is, the Fed will lay out these careful plans and they'll pat themselves on the back, and then the market will reject it, and within 2 weeks, they'll change everything. So yes, what will happen is inflation will creep up, and the Charlie Evanses of the world, who last month said, oh, we at the Fed could see 2.5% inflation without moving rates, and Rich Clarida, the vice chairman, put out a very wonky academic paper talking about why the Fed could see the average inflation rate run over 2%, and they wouldn't adjust policy. And I've always answered the question, it's not their call. It's the market's call. If inflation starts moving up and the market at some point says, enough, I don't like it, and bonds sell off and rates go up, they'll be within 2 weeks of changing policy, because they'll have the market will force it upon them that they have to start to change policy then at that point. So I think that you're right that they're not going to want to do it. They're going to be forced to do it at some point. And the last thought for you, Eric, one of the Fed's favorite measures of inflation is the core personal consumption expenditure, or core PCE. If that number hits 2.6%, that would be a 28-year high. Now, when I say inflation, especially certain people of an age, they'll start thinking 10%, 7%, something like that, 5%. Others will think 1,000,000% because they're thinking of Zimbabwe or something like that. And when I say, how about 2.6 on core? They look at me, that's not inflation. I was like, well, it's a 28-year high and interest rates are 1.1. That would put you with a deeply negative real rate. That's a good place to start. So when I talk about inflation, I'm not talking about some big, gigantic number. Maybe that's 2, 3, 4 years down the road, but it wouldn't take much now. And if you got to 2.6, Charlie Evans will say, no big deal. We told you that we would hold the line here. But like 2018 and 2020, if the bond market rejects it, the Fed will be forced to move in kind.
What's the play for investors? If you see this inflation on the horizon, is it long commodities? Is it something else? What do you do to trade this?
Well, yes. The answer is I think that the traditional inflation plays have been working. Short bonds, they're at 1.11, 1.11 10-year yield as we record. Long commodities, long industrial stocks and basic material stocks relative to the entire market, that is, as well, too, should continue to do better. But I also want to put a little nuance on it. What determines interest rates from an economic standpoint? Why are some countries' interest rates at 10%, others are negative, ours are at 1%? And the answer is expected nominal GDP, expected nominal growth. Now, nominal growth is real growth and inflation. Now, for the last 25 years or so, whenever interest rates went up, it was real growth expanded. And that was good. And everybody's like, okay, that's more profits, more jobs, better standards of living. Interest rates are going up. That's fine. That's why Wall Street thinks of rising rates as a sign of prosperity. But if instead nominal growth is being driven like it was in the 70s up and the 80s down by inflation, that's not so good as well, too. From 1966 to 1982, the stock market lost 2/3 of its after inflation value. Stocks were not a good inflation hedge. They were among some of the worst inflation hedges. It wasn't until the mid-1990s that they recovered all of that lost inflation value. So in that environment, we're talking a lot about the phrase on Wall Street is reflation. Well, the commodities work in that, the basic materials, the industrials work in that, higher interest rates work in that. But if it morphs over to inflation, which I think it will, going from R to I, those same plays still work. And that's what the trick is when people say, what's the inflation play? And I say what it is: commodities, industrials, basic materials, cyclicals, if you want to throw those in there as well too, higher rates. They look at me and say, well, isn't that the same as the economy booming? And don't we want the economy to boom? And I was like, that's the trouble. That's the tough part about it is they start off the same way, but it can morph into inflation. Now, just because we haven't seen it since the early 1990s, everybody's forgotten about it, but it could come back as inflation, and then the bond market could really have a problem.
Jim, when I hear somebody say that, I always tell them that a booming economy is defined by Treasury yields in the 5 to 10% range. We have Treasury yields in the 5 to 10 basis points range. Is it as simple as I make it? It seems to me like you just can easily debunk any strong and vibrant economy argument just by Treasury yields alone. Am I missing anything there?
I think you're right. And I think the problem with Treasury yields is, in the stock market, there's an argument about a moral hazard because the Fed's got your back. There's a perception that there's no risk. So go ahead and speculate to the moon in the stock market. Okay, I get that. And that's true. But it's worse in the bond market. The Federal Reserve owns 30% of all Treasury notes and bonds right now. They're buying them at a clip of $120 billion a month right now. So you've got a lot of people that are in the bond market and they're, you go, why are you owning yields at 1.1%? And you've heard people say that the Treasury market has no value, it's overvalued. It's been that way for about 12 years now because you've got this big buyer with a printing press that's suppressing these yields right now. And they haven't been tested with this idea of inflation because it hasn't been existed in the last 12 years or so. But if they do get tested with this inflation argument, then I do think they're going to get tested. I've used this metaphor many times, that the Fed is like a post in the ground and the market is a horse tethered to the post. And so the horse stands there right where the Fed wants it because it sets where it wants to put the post. But if that horse ever gets spooked, and inflation would spook it, it's an 1,100-pound animal. It can rip that post right out of the ground and go wherever it wants. And we've seen that with the BOJ and with the ECB, that at times when their bond markets get spooked, they'll just flatten their central bank as well. So if our bond market gets spooked by inflation, the Fed will be there and they've been buying the market and the yields have been low, but the bond market will just, rip the post right out of the ground and go where it wants.
Jim, I want to move on to the pandemic situation. I can count on one hand the number of people in finance who were ahead of me in seeing this pandemic coming and predicting what it would mean for markets. You are the absolute top of the list. And in fact, it was your charts and graphs that really persuaded me that a pandemic was imminent back in January of last year. So as the man who was probably the first I can think of to have called this, any new insights, or what are you thinking in terms of the strains and the various things that are going on in the COVID crisis?
Well, I think there's two things. First of all, there are the potentials of new strains, and I don't know enough about the new strains to say other than that they're an undefinable risk. But what I am looking at is the pace of vaccinations. And, the CDC and WHO have some really good data. Bloomberg has actually put this together. If you Google Bloomberg Vaccine Tracker, they've got a very good page that they keep up to date in real time. And I want to focus on the country of Israel. And the reason I want to focus on Israel is leading the world right now when it comes to vaccinations. 55% of their population has gotten at least one of the two doses. 20% of their population has gotten the second dose or the full vaccine. Now that compares, if you want to compare that to another country that's running way ahead on the scale, is the United States. The United States is actually doing a very good job, but we've only got 1.9% of our population with two doses versus 20 in Israel. And we've only got 8% with one dose versus 55 in Israel. If you look at the numbers in the infection counts in Israel, they've peaked about a week ago at around 7,500 on a rolling 7-day basis. And they're down, about 1,000 to about 6,500 or so right now. And I look at that and I say, okay, they needed half their population to get one dose and nearly a quarter of their population to get two doses just to put a peak in. And then I think about the US and I'm like, okay, so that's 150 million people with one dose. And that's roughly 65 million people with a second dose before we could really start to see a bend in the curve. And Biden is pushing 100 million shots in 100 days. This is going to take the bulk of 2022 at the current pace we're going with these vaccines in order to maybe make some real headway. And that's just the US. Remember that all it takes one person from one country to come into your country with a new strain and infect it everywhere. So we really need to get these vaccines worldwide. It could be well into 2022 before we've vaccinated enough of the world and enough of the United States to say it's worked. We've now effectively gotten herd immunity. And again, this assumes no mutation that comes along that makes the vaccine less effective.
Jim, one of the things that I hear quite a bit is concern that younger people in the United States have concluded that there are risks inherent to the vaccine. There's no risk of any consequence to them of actually dying from this disease. Therefore, they don't want to take it. And of course, the counterargument is that society needs them to take it in order to achieve herd immunity. They're not buying it. They're saying, hey, I'm not going to risk my own health in order to contribute supposedly to herd immunity, which is an unproven concept. Do you think that's going on, and is there a way to measure it? I mean, logically it makes sense, but I don't know if that's true. Is there a way to tell from the data?
Well, there is and there isn't. A couple of things. So according to the surveys, the polling that's been done, somewhere between 50 to 70% of the public is willing to take the vaccine, or restated, 30 to 50% of the public is not interested in the vaccine right now. I've argued, you could probably get into April or May or maybe even June before you even get to those people. So if you vaccinate, 40% of the public, or so 40% get a first jab, maybe they'll come around a little bit on that data, on their thinking about it, because right now they're all afraid of it. And like, well, wait a minute, 100 million Americans have gotten vaccinated and nothing terrible's happened, and maybe they'll soften up a little bit at that point. As far as young people thinking that they're bulletproof, I'll just give you one anecdote, and this is from this weekend. One of the guys who works for me we're in Chicago, and he's very smart. He's spending the winter in Laguna Beach, California. I'm here shoveling 15 inches of snow. So you know who the smart guy is right now in this equation. And he told me that Friday in California, they lifted the lockdown bans. And he said Laguna Beach went from a ghost town to Mardi Gras in less than 24 hours. Every bar was packed. They were flowing out into the streets. No one was wearing masks. They were drunk. They were partying all over the place. And he concluded by saying to me, we're going to have to go back into lockdown in about a month because his cases are going to spike right back up all over again. So yeah, this is a real problem because it seems like we're binary, both in Europe and the United States. It's either we're in lockdown and we scream that the government is imposing an undue burden on us, or we go from 0 to 60 miles an hour instantly and everybody's Mardi Gras at that point. And it's not like we can have some kind of middle ground right now. So I fear that, this is why we have these certain waves. We do what's necessary to slow the transmission. Then we ease up and the transmission picks up. Then we slow it. Then we ease up and the transmission picks up. Wash, rinse, and repeat. So we're not there yet. And I think that people that are thinking that we're going to be there, say the financial markets, that we're going to be there shortly and this is going to be behind us soon, they might become a little bit disappointed as we move forward.
I completely agree with you on that. This crisis, unfortunately, is getting worse, not better. And yes, there is a light at the end of the tunnel thanks to the vaccines, but that's a distant end of the tunnel. Jim, let's move on to Wall Street bets and what's been going on in the revenge of retail, if you will. I know that you wrote an interesting piece on Bloomberg. You were also interviewed recently on Fox. I had a chance to read and watch both of those. Last week, the story was GameStop. This week, the story seems to be silver. What's going on here? Who's behind it? What should we expect?
Okay, so I think that there's been a paradigm shift on Wall Street. That paradigm shift has started, as we all know, many years in the making with the availability of information on everybody's fingertips and on their phones. There's very little data or analysis that sophisticated institutional investors have that a retail investor cannot get access to, and most of it is free. But the institutional investor has a cost advantage. Well, in 2019, that cost advantage went away because we went to zero commissions. Well, the institutional investor has a size advantage. Well, early last year, the size advantage went away with fractional share purchases. You like Amazon and it's a $3,300 stock and you don't have $3,300, don't worry about it. You could buy a tenth of a share for $330, no commission. But we don't have any money to really play on this. Don't worry, the government mailed you a lot of money, so you can open up your account with as little as a few $100s as well. Well, I'm sitting at home and I don't really know what to do. Don't worry about it. We've got several social media websites. Obviously, the big one is Reddit and Wall Street Bets. There's StockTwits. There's Seeking Alpha. There's FinTwit on Twitter. There's a lot of others. If you follow along on those communities, you can learn a lot more about the market, or you could just be one of the large momentum traders in those communities. So I think that we've now, in total, have created this big player that has organized through social media. It has got millions of players. There's more than 7.5 million people now signed up on Wall Street Bets. And that doesn't even include the ones on FinTwit and everything else. It gets to be very, very large numbers. And even though they're all small, they could move in different directions. They're also playing in the options market, and that's the so-called gamma squeeze. Right now, the option market is being dominated by small traders. In fact, I even tweeted out the day we're recording that the options market has now become the domain of the small trader. It used to be one of the most sophisticated institutional tools, but now the small trader is working in that market. And we've seen them win along the way repeatedly. Back in May, Warren Buffett sold his airlines, and he said, I wish the airlines well, but I don't see a prospect for them. And a bunch of people led by Dave Portnoy, Davey Day Trader, said that Warren Buffett's, old and past his prime, and he's wrong on the airlines. And they banded together and they doubled the price of the airlines in a month. And the price today is even higher. So for now, the retail investor won by beating Superman, Warren Buffett. Then the retail investor said, stuck at home. I think that these work from home stocks and these emerging technology stocks, these are the new trends. But these active managers that work in big office buildings in Boston, they think they're overvalued. They don't want to touch them. They're not part of the S&P 500. So they started buying all of these racy, non-profitable tech companies, and they've gone up hundreds of percent since they've bought them. They won again. Highlighted by the big one was Tesla. They ran Tesla up from $100 in March to over $700, and it got it to be the fifth largest stock, and it's now part of the S&P 500. They won again there. And then you get to what's happened now. Now, a different type of crowd is on Wall Street bets. That's the retail trader, not maybe the retail investor, which I was describing before. They were looking at GameStop because it had the single largest short interest on the New York Stock Exchange, well over 100% of the float, which should be illegal. In most terms, you can't short more than exists as well. And they pointed out no less than Melvin Capital being in the middle of that trade. And they were talking about, we need a catalyst in order to basically squeeze the shorts. This goes back to October that this was out there on this. And that catalyst came in mid-January. There was a big surge of put buying. And then Citron Research put out its short recommendation on GameStop. And a bunch of people on Wall Street Bets said, this is it. They just rang the bell. It's time to squeeze these shorts. And we know what's happened in the last 10 to 14 days or so with an extraordinary short squeeze. And now we're on the backside of this trade as well, too. At its basis, what they're doing in a lot of these cases is Wall Street operates under its own set of rules. At a minimum, what these shorts were doing in GameStop and a lot of these other meme stocks, as they call them, was they were doing imprudent risk management at a minimum. They should have never had shorts that big, maybe even illegal, because it should never get that over 100% of the float. But the SEC is not doing anything about it. The SEC was invented in 1933 because of abusive short practices in the 29 crash. And they're 90 years later, and they still can't get their act together in trying to rein in abusive short practices as well, too. They all looked around, and maybe there was a little bit of arrogance. If you could be like a fly in the wall 3 weeks ago and said, hey, guys, isn't 100% short kind of risky? I think the answer would have been, yeah, well, who's going to do anything about it? You think Goldman Sachs is going to stick it to us? You think JP Morgan's going to stick it to us? You think another big hedge fund's going to stick it to us? Yeah, it's not risky if no one is big enough or interested enough to stick it to us. Well, we found a group that's big enough and interested enough to basically play their own rules against them. And that was this short crowd. And how do we know that we're playing together? Because what is the first thing they did when Melvin Capital ran into trouble? Bailed them out. They got big bailouts from Citadel in 0.72. Let me contrast that to 20 years earlier, 23 years earlier to be exact, long-term capital. When long-term capital was in a big trade that had imprudent risk management, what did the other hedge funds do? They shot and killed them and basically almost blew up the whole market at the same time. But today, when we see somebody doing something imprudent like long-term capital, we play along and we protect them. And so that's where I think that the Wall Street Bets crowd is the big game changer right now, is that they are now looking at Wall Street's way of doing business and saying, I could take advantage of that. And they have repeatedly. They took advantage of the small stocks because they weren't in the indexes, and the Graham and Dodd value investors at active managers didn't want to touch them. And now they took advantage of a big giant short squeeze as well, too.
Jim, it's interesting because I agree with many parts of what you say, but there are some aspects of this where I think we are in disagreement. So I'd love to run my ideas past you and have you critique them, because the place where I don't think this all adds up is the narrative you're hearing is, okay, what happened here is a bunch of Wall Street outsiders, retail guys, normal, ordinary, hardworking men and women who have nothing to do with this corrupt industry of Wall Street, figured out how to beat those stinking hedge fund guys at their own game. Hallelujah. Well, first of all, if that's actually true, I say double hallelujah, because I think the Wall Street hedge fund crowd deserves exactly what they got. But I don't think that's what happened. I think that Wall Street insiders who understood the opportunity to put this squeeze on GameStop, borrowed the playbook of terrorists. And what we've learned from the last 20 years with terrorism in the Middle East is if you get young men, particularly young men who have been through very traumatic childhoods, and you fill their heads full of enough passion for their cause that they're willing to trade their own life for the cause. You get a small army, but an incredibly powerful army because they're willing to go and be suicide bombers and do things that are not in their own best interest for the cause. And what I see going on here is somebody who was very smart and understood exactly what it takes to put a short squeeze on and knew to wait for the catalyst and all the things that you said. I find it very hard to believe that a Davey Day Trader type of character was smart enough to figure all of that out. Certainly not Dave Portnoy. Somebody was smart enough to figure all of that out. I'm guessing that they were Wall Street insiders, other hedge funds. And I think what they did is they played the Wall Street bets crowd and said, look, they were very quiet, probably starting in October, putting their long positions and their option, their calls and everything on GameStop. And then they very dramatically pulled the trigger, and they got an army of young people who don't really understand how these markets work and what they're doing to be the sacrificial wolves, because it's not just the guy who bought at $22 when it first started moving up. It's when you got to $502 before it went to $504 or whatever the top was, that some retail guy is still buying there. So yes, there's a handful of retail people that made an absolute killing, and you're hearing about them on the internet, normal, ordinary mom and pops who followed the advice that they saw on Wall Street bets, made 20 times what they invested or 50 times, whatever it was. I think there's a larger number of people who lost their shirts because if you look at the volatility and what happened in GameStop, the guys that were buying at the top totally, completely got nailed on this. And I think they were sacrificed by somebody who knew exactly what they were doing. And that what they knew how to do is they said, we're Wall Street insiders. We know that most people, especially young people in this country, hate our guts. What can we do? We can tell them that we're on their side. We can do it on social media, on the internet, so it looks to them like we're them, even though we're not them. And we'll get them to believe that we're getting even. And the thing I find most interesting about this, Jim, is I've read several accounts from people who did lose their shirt and say they have no regrets because they're so proud of themselves for having participated in a movement to do the right thing, to stick it to the man, that they don't care that they lost their money. That's the reason I invoke the analogy of suicide bombers. These people have been deluded into believing that if they lose all of their money, it's for the cause. The cause here, I think, was a large number of people on Wall Street bets were played by Wall Street insiders who knew exactly what they were doing. That's my take on what's really going on here. What am I missing? Why is it? I would love you to explain to me why it really is a case of people who are Wall Street outsiders beating Wall Street at its own game. I would celebrate and cheer for that. Unfortunately, I don't think it's what happened.
Well, first of all, as a caveat, we don't know what happened. There hasn't been a forensic analysis, and there won't be for some time. So we're going to do some suppositions here. And I think that you're right that the masters of the universe, to quote the book Bonfires of Vanities about hedge funds, they jumped in. But what happened with them is that they're no longer the people setting the agenda. They're basically momentum traders like everybody else. And you're right, Dave Portnoy didn't figure this out. Dave Portnoy knows who to listen to, and he basically follows along with the rest of them as well, too. I think this started with retail investors on these boards, and I think it might have got exacerbated by some hedge funds jumping in after the squeeze started. S3 Partners does a good job of estimating, and how always has, of estimating short interest on a daily basis. And they estimated that on Friday morning or Thursday's close, the short interest in GameStop was something along the lines of 113% of the float. And that by Friday night, 24 hours later, so Friday, it had fallen to like 51%. So in other words, 57 million shares were short, and it went down to 27 million shares short just on Friday. What also happened on Friday was the price hit $400. Now, it hit its absolute peak on Wednesday, but then we had that shutting down of trading on Thursday. What it looks very clear to me about is that Friday, it looked like the $400 buyer was a short cover. And then all of those nosebleed level buyers was more a short cover than it wasn't a short cover as well, too. And I think that in total, Melvin Capital lost 53% of its money. I guess we're going to call them Melvin Half Capital now. We know that Point72 took a big loss. We know that D1 Capital took a big loss. We know that Maple Lane took a big loss. We're waiting on all of these funds to basically tell their investors what their January returns were. They usually tell them on February 1st. A lot of them haven't said anything. That should be a sign of what happened to the hedge fund community. In total, I think the hedge fund community came out of this worse than the retail investor. Now, there's 7.5 million people out there. Did somebody lose their shirt? I bet they did. Davey Day Trader took a $700,000 loss, but that's not catastrophic for him. He'll live. He might even make it back by the end of the week, given the extreme volatility that guy trades with as well, too. He might lose it again before the end of the week. But in general, if you were to ask me, big picture, what happened here? I think it was a lot of retail investors. And a lot of these people, like 95% or 98% of them are trend followers. There's a group of influencers, just like all social media, that basically told them, guys, let's go. And they went. And when the stock started moving, a bunch of professionals on Wall Street said, we got to get in on this. And then, so they were there too, but they weren't the initiator of this trade. It was.
Well, we don't know who the initiator of the trade was, to be fair, right?
Right. To be fair, there is, yes, because we're talking supposition. We don't know who the initiator of the trade is. We do know that some of the names of some of the more prominent people on Reddit have been coming out, and we're finding out that they are, in some cases, the guy Roaring Kitty, who, I can't believe in we're talking about Wall Street, we have to use the name Roaring Kitty, but that's what 2021 has brought us to. He was one of the big proponents of all of this on Wall Street. He's a wealth manager, a 34-year-old wealth manager with a CFA. So he's not, he doesn't work for a big billion-dollar hedge fund, but he's not ignorant of the financial system because he's already got a CFA and he's been pushing these kind of trades as well, too. So, and then if you go back and go, they bought the work from home stocks. Who bought Tesla? Who was ramping Tesla up 600%? Who embarrassed Buffett in the airlines? Who's been buying cryptos to get Bitcoin to, get briefly over 40,000 as well, too. I think this crowd is a big dominant crowd. And I want to emphasize my take on this is they're looking at kind of the way Wall Street does business. And they're saying, these guys, we could take advantage of this because they don't think there's anybody else out there that can come in and play this. Now, with that said, I think this is the last short squeeze. No one is ever going to be caught short in a big way in a stock again. Pershing Square, Bill Ackman's hedge fund, last night put out a statement that they have no short positions as of the end of January. Why did he feel necessary to do that? And I think, my friend Bill Fleckenstein was quoted last week as saying, and Mark Cahutis, the big short seller, they think this is going to destroy the short selling business right now. Short selling is a necessary thing, especially the way that the Jim Chanos of the world do it. They identify fraudulent companies, they put on a position, they explain why they're fraudulent companies, and they profit. They take their risk and they profit on it, and they probably make the world a better place because they get rid of bad companies and bad actors. Of course, now we've abused that short selling a little bit too much, and that's what they took advantage of. But if we're going to wipe out all the shorts, I think we're worse off than we were, then we'll be worse off without the shorts. We should have found a way to not let the system get abused in the first place so that we're going to go too far the other way. That Bill Ackman, who runs a long-short fund, basically just announced he's a long-only manager. He doesn't have a single short, and he's afraid to put one on right now.
Let's move on to the next chapter in this story, Jim, because frankly, if I were to grade the job that whoever designed, initiated, and orchestrated the squeeze on GameStop, that's A+++ in terms of somebody understanding the market mechanics, how it works, how to engineer a short squeeze. They absolutely aced it. Now we move on to this week's sourced from Wall Street Bets squeeze on the silver market. You'd have to be about the stupidest gold bug idiot on the planet to believe that Wall Street Bets is going to squeeze silver to $1,000 an ounce, which is what the nonsense that's coming out of there says. Now, I cannot for an instant believe that it's coming from the same accounts on Wall Street Bets, but in the perception of a lot of people, it's like last week, Wall Street Bets totally killed it with this squeeze on this GameStop, whatever that is. I don't really understand the mechanics of how it works, but my God, they made a fortune, and now they say it's silver. This is a can't lose. Gotta just go. And my favorite part is in the one of the things that I read that came off of Wall Street Bets. The way to squeeze silver, according to them, is to buy PSLV, which is a closed-end fund, which indicates whoever wrote this has absolutely no concept of what they're talking about. But people are perceiving this as, hey, Wall Street Bets last week totally nailed it. This is, I can't lose.
Yeah. PSLV is the Sprott closed-end silver fund, which trades at a gigantic premium as well, too. And there's no doubt that there has been a perception out there that the next big play is silver. If you look at SLV, the iShares Silver Trust, it took in $589 million just yesterday. That was its second best day in history. Its first best day in history was the day before, Friday, took in about $900 million. And its third best day in history was Thursday. So there's been a ton of money that's gone in there. Now, in fairness to the Wall Street Bets crowd, there's a giant debate out there on the Reddit board, whether or not they're in agreement that they should be playing silver. A lot of the players that were successful in this, the screen names that were successful in this GameStop short and have been successful before have been saying, no, we're not doing the silver thing. This is taking on a life beyond us, and we're being accused of it. Others are saying, no, we've got to do this short on silver. So it's unclear whether or not there's a consensus that is formed on silver out there. But after what happened in GameStop, it almost doesn't matter is if everybody believes it, and now the outsiders of, in this case, the outsiders of Reddit, are reading it in the Wall Street Journal, are reading it in Bloomberg News, are reading it in the FT, they're all running into it as well too. So it's unclear whether they're doing this trade. And I agree with you. It is kind of a head scratcher why they decided that it would become silver would become the trade. I don't get the hook. I don't get what they think the advantage is. Their argument is that there's not enough cash bars in the world. There's not enough silver coins in the world, so that if we ramp up the paper silver markets, then the hedge, either they'll have to buy cash or the hedgers will have to buy cash that sold them some other put option or something like that to protect themselves. And that they'll eventually squeeze the cash market to the moon and force the paper PSLVs and SLVs up with them. That's sort of the argument they're making. I understand the argument, but I'm not sure it's right. The silver market probably better than me. Does that make sense to you?
I think what's going on here is somebody who believes in the nonsense that's been circulating in the silver market for decades is taking the old story of the supposed secret cabal of bullion bankers that are suppressing the price of silver. And what they're doing is people who don't understand how the market works. One gentleman in Florida in particular, whose name I won't mention, publishes a newsletter saying, look at the commercial, just outsized shorts on the Commitment of Traders reports. Obviously, these people have this massive short. They're trying to force the market lower. Now, of course, you and I understand, Jim, the business that bullion bankers are in is not taking risk. So when they have a large vault full of physical silver longs, they balance that with paper shorts in the futures market. And that's the way they hedge market risk. So there is no, conspiracy to suppress the price of silver. But people who don't understand how to interpret commitment of traders reports have been pushing this story for years. I think what happened is somebody who believed that nonsense is a member of Wall Street Bets and said, hey, our next play should be, the most crazy opportunity I've ever heard of a bunch of corrupt bullion bankers being short that we could squeeze out is this stinking situation in the silver market. It was always bullshit for the last 20 years that these ideas have been circulating. They've never been true, and they're not true now. But I think that after what happened with GameStop, which was a brilliantly engineered short squeeze, they're saying, we've got the power. The people can take on Wall Street. Let's do it. And so, I own silver, so I'm all for people irrationally bidding up the price of silver. That's just fine with me. But they're not going to squeeze any shorts out of the market. They're not going to take it to $1,000. The notion that they have that they're somehow going to consume the available supply of physical silver. What they think is supposedly going to happen is if they keep buying SLV physically owns bullion in a vault to back its holdings, which means they have to buy more bullion. They'll run out of physical silver, and they've got this nutcase idea that's been circulating for decades where supposedly the physical price is going to decouple from the paper price. And then what they do is when, very predictably, the price of retail coins and bars decouples from the wholesale price of physical silver, they misinterpret that. And they say, look, the paper price and the physical price are different now. There's a huge premium on physical. It's because the paper market is crumbling and it's about to collapse. That's nonsense. The paper price and the wholesale price of 1,000-ounce silver bars is still the same, except for a small amount of basis between the front-month futures and the spot market. The real difference that's occurring is the difference between the cost of those 1,000-ounce wholesale bars and the retail products like coins and retail-sized bars, which have a huge premium on them because a whole bunch of people are falling for this nonsense. So I don't think it's going anywhere. I mean, they can certainly bid up the price of retail coins and bars. The retail precious metals dealers are going to love them. Maybe the retail precious metals dealers are behind this. Don't discount that possibility. But I do not think they're going to squeeze anybody out of the market or cause a run on physical silver deliveries that results in, $1,000 an ounce price or whatever they think is going to happen. I think that's completely diluted.
So I agree with you, and I've always been dubious of this silver idea as well, too. But let me also, for the listeners, point out something else that seems to be evolving. And you want to talk about stick it to the man. Think about this. First of all, there is something that's very healthy that's going on Wall Street Bets, and it's two words. The first one is loss porn, loss, P-O-R-N, porn. And what that is that no one is allowed to go out and brag about their winners unless you brag about your loser. And when you say loser, I mean, I want a screenshot of your trade ticket that you actually bought this thing and got killed on it. And they celebrate their losses as much as they celebrate their wins. That's why, as we speak today, Dave Portnoy tweets out, I took a $700,000 loss getting out of all my meme stocks. They're completely fine with telling you that this game is like baseball. If I fail 7 out of 10 times, that means I'm successful. 3 out of 10, I'm a 300 hitter. I get paid riches. That's healthy. I wish more of Wall Street would do that instead of trying to pretend that all the smart guys bat 99% on every trade that they do. They don't. And so that's good. And then the other phrase you'll hear from them a lot is the phrase YOLO, which if you're not familiar with it, it's you only live once, or their version of Carpe Diem. And the reason that they talk about YOLO options is what they're saying is, hey, this is extraordinarily risky. And you have a high degree or high percentage chance you're going to lose all your money. But YOLO, you only live once. And if it works, you're going to become very, very rich. So understand that there's a tremendous amount of risk. And oh, by the way, look at my loss porn over here. I've blown it before in the past. If that came to regular Wall Street, that would actually be a very healthy thing, at least in terms of framing expectations about a lot of stuff. And like I said before, these hedge funds, they can't report they haven't reported their January numbers yet. And I think a lot of them are afraid to, because some of them don't have very good numbers. And let me throw out one other thing that seems to be going on about really sticking it to the man. Activist shareholders. There's a rumbling out there that maybe they should get into activist shareholding. And the name Larry Culp is coming up. He's the chairman of GE. Now, if you're one of these millennial suicide bombers that you're talking about, and I don't think that's an inaccurate description of what some of the momentum types are thinking about right now, it's easy to look at GE, which is now an industrial company, and its history and its problems and the dirty things that they make, and say, okay, I hate them just because of who they are. Then you point out that Larry Culp is standing to make a $47 million payday if the stock can average over $10 a share, and a $230 million payday if it can average over $16 a share. And there's some nascent arguments out there. Let's prevent that from happening. Let's sell this stock down, short it, whatever we need to prevent Larry Culp from getting his payday. Now, they're just talking about this. This is kind of over in the corners, but there is some idea that they might try to morph themselves into activist shareholders as well, too. This is a big community. This is a lot of money in aggregate, each individual account being small, and it could go a lot of different directions. And we'll have to see where it goes forward from here. And that's why I'll push back on the idea that it's being engineered by Wall Street hedge funds. I don't think it's being engineered by them, but I do think that they've been reduced to the millennial suicide bombers. As soon as they can figure out what the next trend is, the Wall Street hedge funders will jump in on it too, because they think that the power of this crowd will just make the momentum work for a while.
Jim, I agree emphatically, and I should clarify my earlier comments. I completely endorse the fact that good things are happening on Wall Street Bets. It is wonderful to see retail traders finding the power of the internet and collaboration to help one another stick it to the man, and the man deserves to have it stuck to him. I agree with that. I cheer it. Please don't anybody think that I don't want to see you guys succeed at sticking it to the man. Just be aware of the possibility that the man might be hiding behind a screen name, pretending to be someone who he isn't, and playing you. These guys are as sleazy as they come. In any event, Jim, we're running out of time, so we're going to need to leave it there. But before I let you go, please tell us a little bit more about what you do at Bianco Research.
It's an independent research firm. I'm not affiliated with any brokerage firm or any money manager, have not been for the entire existence of the firm. And we do more macro research, and it has a bit of a fixed income flavor to it because that lends itself better to macro. But as you can see, we don't exclusively stick with fixed income. And it's available as a product, if you will, not a formal newsletter, but a product for people that want to purchase our research. And I also am active on Twitter at Bianco Research. BiancoResearch.com is our website. You could go see what we're about. You can follow me on Twitter as well too, get some ideas of what we're talking about. Now, my Twitter timeline in the last week has been dominated by this Wall Street Bets thing, but if you looked back 2 or 3 or 4 weeks, it was something completely different. And in 2 or 3 or 4 weeks, it might be something completely different again as well, too. That's the nature of being a macro researcher. We kind of seek out what is the issue of the day and try and add to that conversation as best we can.
Patrick Ceresna and I will be back as MacroVoices continues right after this message from our sponsor.